Welcome to Elite Finance Insights, your gateway to the financial secrets of the world's most iconic success stories. Every tip we share is a key to the strategies once reserved for the elite. Ready to unlock your financial potential? Let's dive in. So it's Wednesday again. You know what that means. Today, as always, we have our special weekly update where we break down 3 crucial economic events shaping the US market. We'll reveal the most impactful news of the day and explain how these developments might influence your investments, whether it's in crypto, ETFs, or other market sectors. Stay tuned as we dive into today's market-moving insights. Our first major news item comes from the Federal Reserve. Today, the central bank announced a 0.25% increase in interest rates as part of its ongoing strategy to rein in inflation and ensure long-term economic stability. The decision comes after months of careful observation of inflationary pressures and a series of economic indicators that suggested the need for a tighter monetary policy. In the immediate aftermath of the announcement, markets reacted with a mix of cautious optimism and volatility. Investors are now assessing the implications of higher borrowing costs for both consumers and businesses, especially in sectors that are highly sensitive to interest rate changes such as real estate and technology. In the short term, the rate hike is expected to result in increased volatility in equity markets. Companies that rely on low-cost financing might see their profit margins compressed, and investors in growth-oriented sectors could become more selective when it comes to allocating capital. On the flip side, financial institutions such as banks may benefit from a wider interest margin, while bond markets could experience a shift as yields adjust to the new rate environment. This balancing act underscores the Federal Reserve's challenge of curbing inflation without stifling economic growth. Long-term investors may see this move as a signal that policymakers are serious about maintaining stability, even if it means a period of adjustment as the economy absorbs the impact of higher rates. For those of you invested in ETFs that focus on sectors like technology or consumer discretionary, this rate hike may encourage a review of your portfolio allocation. Diversifying into sectors that historically perform well in a rising rate environment could be a prudent move. Meanwhile, the cryptocurrency market, which has often been sensitive to shifts in investor sentiment, might see short-term fluctuations as traders reassess risk in light of tighter monetary policy. It is a reminder that in today's interconnected financial landscape, a decision by the Federal Reserve has ripple effects across every asset class. Investors should remain vigilant and keep a close eye on further communications from the Fed, as hints about future moves can have a significant impact on market expectations and asset prices. Moving on to our second news item, the latest U.S. employment report has just been released, and the numbers are nothing short of impressive. According to the most recent data from the Department of Labor, the economy added a substantial number of jobs last month, with robust gains seen in industries ranging from healthcare and technology to manufacturing and retail. This surge in job creation is not only a testament to the resilience of the U.S. economy, but also a sign that consumer spending is likely to remain strong in the coming months. A healthy labor market typically translates into higher disposable incomes and improved consumer confidence, which in turn can drive revenues for companies across various sectors. In the short term, the strong employment data is expected to boost investor sentiment and support market rallies, particularly in sectors that are closely tied to consumer spending. With more Americans back at work and earning steady incomes, retailers and service providers may experience a surge in demand. However, there is a dual aspect to this story. As employers compete to attract and retain talent, rising wages could eventually lead to increased operating costs, and may contribute to upward pressure on prices. This dynamic has the potential to complicate the Federal Reserve's ongoing efforts to manage inflation. For investors, the employment report provides a mixed yet largely positive signal. On one hand, growth-oriented sectors such as consumer discretionary and technology could see enhanced earnings prospects driven by increased spending. On the other hand, sectors that are sensitive to rising labor costs may need to adjust their strategies to maintain profitability. Exchange-traded funds that focus on companies with strong fundamentals and robust employment-related trends could be well-positioned to capitalize on this momentum. Over the long term, a strong labor market also lays the foundation for sustained economic growth, as increased consumer spending fuels business investment and innovation. It is essential for investors to weigh both the positive indicators and the potential challenges that come with rapid job growth, and to consider these factors when adjusting their portfolios to remain aligned with evolving economic conditions. Our third news item today focuses on a significant regulatory update that is capturing attention across financial markets. The Securities and Exchange Commission has unveiled new guidelines aimed at clarifying the regulatory framework for cryptocurrency markets. This announcement marks a pivotal moment for digital assets as it seeks to establish clearer oversight for exchanges and asset managers while enhancing investor protection. In the immediate aftermath of the SEC's announcement, market participants are likely to experience a period of adjustment as they interpret the new rules and assess their impact on current and future investments. In the short term, the guidelines may lead to a rebalancing in the cryptocurrency market, with investors repositioning themselves in response to the perceived reduction in regulatory risk. This shift could result in increased stability and transparency, which many see as necessary ingredients for long-term growth in digital asset markets. However, there is also the possibility that certain segments of the market may experience temporary volatility as traders adjust to the new compliance requirements and reporting standards. From a broader perspective, the SEC's regulatory update holds important implications for ETFs and other investment vehicles that have exposure to cryptocurrencies. By establishing a more defined regulatory framework, the guidelines are expected to reduce the ambiguity that has previously deterred some institutional investors from entering the market. Over the long term, this could pave the way for the development of innovative financial products that integrate digital assets into traditional investment portfolios. That said, it is important for investors to remain cautious. While greater regulation can enhance market stability and investor confidence, overly stringent rules could inadvertently stifle innovation and slow down the rapid pace of growth that has characterized the crypto sector in recent years. Investors should view this development as both an opportunity and a challenge. The clearer guidelines may lead to increased transparency and improved market practices, which are likely to benefit all participants. At the same time, the implementation of these rules will require ongoing dialogue between regulators and industry stakeholders to ensure that the balance between investor protection and market innovation is maintained. As digital assets continue to evolve, staying informed about regulatory changes will be crucial for anyone looking to invest in this dynamic and rapidly developing space. The SEC's announcement is a reminder that the financial landscape is constantly shifting, and that proactive engagement with regulatory news is essential for making informed investment decisions. In conclusion, today's economic update has given us valuable insights into three pivotal areas that are shaping the U.S. market. The Federal Reserve's decision to raise interest rates reminds us of the delicate balance between managing inflation and fostering growth, while the strong employment report signals a resilient economy with both opportunities and challenges for various sectors. Meanwhile, the SEC's new cryptocurrency guidelines underscore the ongoing evolution of digital asset markets and highlight the need for clarity in an increasingly complex regulatory environment. Each of these developments carries important implications for investors, whether you are focused on traditional assets like stocks and ETFs or on emerging sectors such as cryptocurrencies. Thank you for joining us on this weekly Wednesday economic news update on Elite Finance Insights. Stay informed, keep your strategies sharp, and be ready to adapt as the financial landscape continues to evolve. Remember to subscribe for more in-depth analysis and timely updates. Until next time, keep your eyes on the market and your financial potential unlocked.